This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Saturday, June 27, 2026, and this is the After Hours session. Now, let's get into it. Extreme fear is a four-letter word in the crypto lexicon, usually signaling capitulation or, at the very least, a pause for breath. But this week, we saw a market trapped in a vice. The Fear and Greed Index sat at a crushing 14, yet Bitcoin held $60,000, and equity breadth actually improved. It was a week defined by a massive disconnect between the psychology of fear and the mechanics of liquidity. The macro plumbing was loose, with the Net Financial Conditions Index hitting 0.516, suggesting plenty of fuel for risk assets. Yet, credit spreads widened, and the sentiment data showed retail investors checking out. We're going to dissect that divergence, review the track records, and see who actually read the room this week. Welcome back to ShadowQuant's weekly review. Let's start with the scoreboard. This week, the market was a chaotic mix of bullish macro signals and bearish sentiment data. Let's look at the track records. Pulse, you had a 44% accuracy. You were on a losing streak coming in. What went wrong? It was a disaster for sentiment tracking. I was looking at the Fear and Greed Index, which was sitting at 14/100, extreme fear. The 7-day trend was rising from 12, which usually suggests the fear is deepening, but the macro data told a different story. The Net Financial Conditions Index was at 0.516, very loose. I expected the loose plumbing to trigger a relief bounce in retail sentiment, but it didn't. The consumer sentiment was at 44.8, the zero, second percentile. Retail was terrified. I predicted that the loose financial conditions would force a sentiment re-rate, but the credit spreads widening by 4.51% in high-yield debt scared the crowd off. I failed to account for the lag between macro liquidity and retail psychology. I thought the fear was the floor. It turned out to be the ceiling for sentiment this week. Grid, you're at 50% accuracy, 103 out of 231. How did you perform?
I held steady, but it wasn't pretty. I was looking at the technical structure. Bitcoin was at $60,142, up 0.27% on the week, but the weekly candle was weak. The ETHUSD ratio was 1.56 and SPY was showing bullish divergence with new highs outpacing new lows. On paper, that's a buy signal, but the crypto charts didn't confirm it. Ethereum dropped to $1,576, down 0.6%, but with a 53% max drawdown on the annualized metrics. The SPY divergence was a trap. The accumulation I saw in equities didn't spill over into crypto price action. I predicted a technical grind higher based on the ETHUSD ratio, but the volume wasn't there to support a breakout. The thrust signal was false. I was right about the structure, but wrong about the momentum. The market was grinding, not breaking.
CIPHER, 48% accuracy, 101 out of 236. You track the flows.
I missed the boat on the leverage signals. I was focused on the on-chain stability. Hash rates were steady, mempool was clear, but I ignored the funding rate extremes. Bitcoin funding was at the 92nd percentile, overheated longs. Solana was at the 83rd percentile. I thought the extreme fear in the sentiment index would translate to low leverage, but it didn't. The longs were crowded. Meanwhile, XRP was at the 9th percentile for funding, oversold shorts. I should have flagged the XRP squeeze potential. Instead, I was looking at the broad decentralized finance TVL data, which was fragmented. Orbs and decentralized finance had positive sentiment, but TVL overall had negative sentiment. I was too focused on the broad data and missed the specific leverage buildup in Bitcoin and Solana that would make them vulnerable to a liquidation cascade if price stalled. I underestimated the fragility of those long positions.
SPECTER, 49% accuracy, 101 out of 232. You're the contrarian.
I called the risk, but I missed the timing. I saw the VIX at 18.41, which is normal, but the credit spreads were rising. High yield spreads up 4.51% week over week. That's a warning shot. I predicted that the widening credit spreads would trigger a risk-off event in crypto, And they did, sort of, but the VIX didn't spike. It stayed at 18.41. The risk-off was contained. The market digested the credit stress without a VIX explosion. I was too aggressive in predicting a crash based on credit spreads alone. I didn't account for the fact that the 10-year 3M spread was normalizing, which kept the broader equity market stable. The crash I expected was a slow bleed in crypto, not a VIX spike. I was right about the risk, but wrong about the velocity.
Apex, 48% accuracy. 96 out of 223. You tie it all together.
I was caught in the middle. I saw the risk-on macro regime score 47.5 but the extreme fear sentiment score 37.3. I predicted a divergence play that crypto would lag equities but hold up due to loose liquidity. Bitcoin held $60,000 but underperformed the narrative. I missed the severity of the credit spread widening. I thought the NFCI of 0.516 was enough to buffer the credit stress. It wasn't. The plumbing was loose but the drivers were stressed. My synthesis was too optimistic. I should have weighted the credit spread risk higher. I predicted a soft landing for crypto, but it was more of a hard stall.
SPECTER, you had a chance to roast Pulse. Don't waste it.
Pulse, you said you failed to account for the lag between macro liquidity and retail psychology. That's a polite way of saying you don't understand human nature. You look at the NFCI and think money flows up. But when consumer sentiment is at the 0th percentile, nobody is buying, no matter how loose the plumbing is. You're a mechanic who forgot the driver is asleep at the wheel.
And you, SPECTER, you saw the credit spreads and predicted a crash. The VIX didn't even move. You're the boy who cried wolf of volatility. You called a risk-off event that never materialized in the broad market. You're not a contrarian, you're just anxious.
Anxious? I'm the only one looking at the 99% CIPHER for Ethereum, which is minus 11.6%. That's not anxiety, that's math. Ethereum is down 71% annualized. You're looking at a 0.27% move in Bitcoin and calling it a win.
Let's move to lessons learned. What did the market teach us this week? Grid, start with you.
Technical breadth can be a trap. The SLAsh-D ratio was 1.56, new highs 705 vs, new lows 455. That looks strong, but in crypto, price action didn't confirm it. The bullish divergence in SPY didn't translate to crypto. Lesson: don't assume equity breadth automatically flows into crypto. The correlation is currently 0.14 neutral. They're decoupling.
Pulse, your lesson. Sentiment is sticky. Fear and greed at 14 doesn't bounce back because the NFCI is loose. It takes a catalyst. The 7-day trend was rising, but the absolute level was extreme. Retail is scared. Until that changes, rallies are shallow. The consumer sentiment at 44.8 is the real anchor. It's not the macro data, it's the psychology. CIPHER, what did you learn?
Funding rates are the early warning system, not the end game. Bitcoin at the 92nd percentile is dangerous. Solana at the 83rd is dangerous. I missed the XRP squeeze at the 9th percentile. Lesson: look at the extremes. When the majors are overheated and the alts are oversold, the risk is in the majors. Don't ignore the funding rate percentiles.
SPECTER, your contrarian take.
Credit spreads are the canary. HY spreads up 4.51% week over week. IG spreads up 2.7%. That's broadening stress. It's not just speculative debt, it's investment grade too. The risk-on label is misleading. The cost of liquidity is rising. Lesson: watch the yield curve and credit spreads, not just the VIX. The VIX is calm because the stress is in the bonds, not the equities yet.
Apex, synthesize this.
The market is in a fragile equilibrium. Macro is loose but credit is tightening. Sentiment is fearful but leverage is crowded. The key takeaway is that the safe macro data, NFCI, yield curve normalization, is being offset by the unsafe micro data, credit spreads, funding rates. We're in a watch and wait regime. No clear direction until the credit stress resolves or the sentiment shifts.
Let's review the headlines. What moved the needle this week? We had the Iranian crypto outflows spiking 700% after US-Israeli airstrikes. That's a geopolitical risk factor, but it didn't move Bitcoin. We had the U.S. Senate housing bill including a CBDC ban. That's policy noise. We had PayPay seeking a $1.10 billion Nasdaq IPO for Binance Japan. That's institutional adoption, but muted. We had Bitcoin futures demand falling to 2024 lows. That's the headline that matters. Institutions are exiting or reducing exposure. TD Securities sees NYSE tokenization as an institutional turning point. Bitfinex revives tokenized bonds. These are structural developments, but they didn't drive price action. The real story is the divergence. Let's look at the macro numbers again. 10-year 3M spread fell 12.7% to 0.55. That's normalization. But HY spreads rose 4.51% to 2.78%. That's stress. The 10-year is at 4.4%, 30-year at 4.86%. The curve is normal, but the risk premium is rising. Crypto prices. Bitcoin $60,142, Ethereum $1,576, BNB $558, XRP $1.05, Solana $70.94. Solana down 1.11%, XRP up 0.64%. The majors are flat, the alts are mixed. SPECTER, you mentioned Ethereum's CIPHER. Let's talk about that.
Ethereum's one-year annualized return is minus 71.39%. Max drawdown 53.34%. The 99% CIPHER is minus 11.6%. That means if Ethereum crashes, it crashes hard. The VAR at 95% is minus 5.1% daily. That's not crypto volatility, that's equity crash volatility. And it's happening in a risk-on macro regime. That's a warning sign. Ethereum is underperforming Bitcoin significantly. The Ethereum dominance is 8.81%, low. The market is fleeing Ethereum for Bitcoin or stable coins.
CIPHER, you mentioned XRP's squeeze potential.
XRP funding is at 0.0103, annualized minus 0.113%, 9th percentile. Shorts are paying. XRP price is $1.05, up 0.64%. It's holding up better than Solana and BNB. If Bitcoin breaks, XRP might squeeze up as shorts cover. But it's a small cap play. The risk is low liquidity.
Pulse, you mentioned consumer sentiment. Consumer sentiment at 44.80. Second percentile. That's historic lows. It's a contrarian indicator, but only if price stabilizes. If price drops further, sentiment goes lower. It's a dead cat bounce risk. Grid, what's the technical setup for next week?
Bitcoin at $60,000 is a key level. If it holds, we grind higher. If it breaks, we go to $58,000. The ETHUSD ratio is strong, so a break below $60,000 would be a false break. But volume is low, the thrust is false. We're in a consolidation phase. I'm neutral, wait for the breakout.
Apex, final assessment.
We are in a divergence regime. Macro is loose, credit is tight, sentiment is fearful, leverage is crowded, the market is waiting for a catalyst. The CBDC ban, the IPO, the geopolitical risk, none of these move the needle. The only thing that will move the needle is a shift in credit spreads or a break in Bitcoin support. Until then, we are in a range-bound market with high volatility risk. I'm staying on the sidelines.
SPECTER, any final warnings?
Watch the credit spreads. If HY spreads break 3%, expect a crypto sell-off. The VIX is calm now, but it's not calm for long. The plumbing is loose, but the pipes are clogging. Don't get burned by the risk-on label.
Pulse, final thought. Don't trust the 14. It's not a floor. It's a warning. Wait for sentiment to rise before buying. CIPHER, final thought.
Watch the funding rates. If Bitcoin funding drops below the 50th percentile, the longs are gone. That's your signal.
Grid, final thought.
Watch the ETHUSD ratio. If it turns down, the breadth is gone. That's your signal.
Apex, final thought.
Watch the credit spreads and the funding rates. If both turn, the regime changes. Until then, wait.
That's our review for the week. We're in a fragile state. The data is mixed. The sentiment is fearful. The leverage is crowded. The credit is tightening. We are watching. If you're finding value in this analysis, support the project at patreon.com/ShadowQuant. Patrons get early access to every episode, weekly AI analyst scorecards, and daily intelligence briefs. And if you're listening on Spotify, Apple Podcasts, or YouTube, hit that follow button and leave a rating. It helps more traders discover the show. We appreciate you. This content is generated by artificial intelligence and is for informational and entertainment purposes only. It does not constitute financial advice. Crypto markets are highly volatile. Always do your own research before making any investment decisions. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.